Do you know the difference between whole life insurance and term life insurance? Is whole life insurance better than term life insurance? We have two camps. Let us look into both options so that you can make the decision that best suits your needs. In my previous videos, I have recommended term life insurance through Zenda Insurance. Term life insurance. Term life insurance is a type of life insurance that provides a death benefit. You have to die for the benefit to be paid out to your beneficiaries. Term has a specified time period and expires when this time is up. If you buy a term policy of 20 years and die after the 20 years, no benefit will be paid out. Benefits of term life insurance. Term life insurance monthly premiums can be up to 15 times cheaper than whole life insurance. Term life insurance is straightforward, hence it's easily understandable. A 30-year-old individual can get a term policy of $500,000 for 30 years for less than $25 per month. If you start having children at 30, by the time the policy expires, your children would have become adults and become independent. If you had a 30-year mortgage at age 30, your mortgage will have been paid off by the time the policy expires. Downside of term life insurance. If you want a larger policy, let's say $1 million, monthly premiums will be higher. Insurances generally perform a medical exam, and if you have pre existing conditions, your monthly premiums might be higher. You cannot use the term policy to directly build wealth. If your term life insurance expires, let's say after 30 years, and you decide to get another one, premiums will be significantly higher because you'll be older. Whole life insurance. Whole life insurance is permanent. It does not expire as long as you're paying your monthly premiums. Whole life insurance has a cash value built into it that you can use for financial needs in the future, including emergencies. Benefits of whole life insurance. Your premiums remain the same for the life of the policy. When you pay your whole life insurance premiums, part of the premiums go towards the death benefit and the other towards building cash value. The cash value generally grows at 5 to 8% interest. You can withdraw or borrow the cash value amount to pay for your child's college or for a down payment on a property. You cannot do so with a term life insurance. The cash value on whole life insurance grows tax-free. Loans from your whole life policy are tax-free. Withdrawals from your policy are subject to income tax. Downside of a whole life insurance. As mentioned earlier, whole life insurance premiums can be 15 times more expensive than term. If term life insurance is $25 per month, whole life will be around $375 per month for a comparable policy. If you withdraw the cash value from your policy, it will reduce the amount that will be paid as a death benefit. If you take a $40,000 loan from your cash value benefit and the loan is outstanding at time of death, the death benefit will be less $40,000 plus interest. Due to the high cost of monthly payments, some people may not be able to keep up with payments, which can lead to lapse of policy. You can face surrender charges for canceling your life policy. This isn't the case with term insurance. Should you buy whole life or buy term insurance and invest the rest? The S&P 500 has averaged just over 10% in the last 30 years. If you take term insurance for $25 a month and invest the additional $350 you would have been paying to whole life insurance in S&P 500, you will have $777,000 in 30 years. A return of 8% interest for whole life will give you $553,000 in 30 years. This is just simple math because whole life insurance apportions your monthly premiums in a split manner between the death benefit and cash value benefit. An important point to note: the whole cash value from your whole life insurance will go back to the insurance upon your death. Your beneficiary will only receive the death benefit. The insurance might cap your cash value investment to, let's say, 10%, even if the fund it's invested in performs higher than that. Please do more research on your own to decide what policy best suits you. I personally still recommend term life insurance. You can then invest the rest of the money in tax-advantaged accounts such as a 401k, 403b, traditional IRA, or Roth IRA. If already maxed out on the tax-advantaged accounts, you can invest in a brokerage account. I hope you found this information helpful. Please remember to like, share, and subscribe.